This is the Alhambra Investments Weekly Market Pulse with CEO Joe Calhoun. An interesting title to your report this week, Joe. You called it the Rational Optimist, and I know that's talking about you. What does that mean to you?
Well, I guess it means I'm pragmatic. I actually just found out because I did not know that there was a book written called The Rational Optimist by a guy named Matt Ridley, who, if I remember correctly, is kind of a libertarian, but it doesn't really matter. So I'll just give him credit for that phrase while we're here. Rational optimist to me is just that, I think it's never paid very well to bet against America. It's never paid very well to be pessimistic about our economy and about our country. And so I've always been optimistic. And I think that I love technology. I think technology, moves us ahead. It always has. Yeah, we get some setbacks like Facebook, but in general, I think that technology continues to advance and it continues to make us a better place. But you got to be rational and you got to be a little bit, careful about your optimism. You can't just be optimistic all the time, no matter what's going on. There are times when bad things happen. But I think if you're an optimist, you know that those bad things and those bad times are going to pass. And I always count on that. And I think this week in particular, I put a little piece at the end there about a wedding I attended this weekend, which I think just, a group of young people that I think proves that we're in pretty good hands. The future's going to be okay.
So let's take rational optimism to next step here, Joe. The Fed meets this week. Jerome Powell has all his implements of destruction ready to inflict the pain he says is necessary to bring inflation under control. How does the rational optimist look at that?
Well, first of all, let me just say that being a Southerner, Mr. Powell and his little speech about pain that he's been giving repeatedly since the August meeting reminded me of a good Southern preacher. A little fire and brimstone. You gotta make sure that people understand it. You gotta atone for those sins, and so I got to thinking about that, and that's why I kind of made that little reference there about ye consumers, you free spending consumers need to repent. You're spending too much. Of course, he doesn't tell us about the part where he stuck a bunch of money in their pocket. So anyway, look, I think the market may be a little too exuberant here. I think people are maybe expecting that Powell is going to use some language that's a little softer, and I'm not so convinced of that. But listen, I do think that it's quite interesting I'll put it this way: if I didn't know anything about macroeconomy, about what's going on with the yield curve and so forth, if I didn't know anything, if all I knew was how sentiment was positioned right now, longer term, and if I only knew the charts, if I could only look at a chart, I have to say I'd probably be, if I'm a long-term investor, I'm probably a buyer here. Short term, we're a little overbought, and I think people got a little too exuberant here in this last couple of weeks since the low in mid-October. But in general, I think things are starting to heal in the market. Now, it's interesting because we don't know what Powell's going to do this week, except he's going to raise rates. He's going to raise 75 basis points. I don't think there's any doubt about that. The question is about the pace of hikes after that. But I would just say too that I'm not convinced that Powell is going to be as aggressive going forward as he'd like to be. I think it's a better way to put it. He has talked about the yield curve and its impact and its signaling ability. Now, he looks at a different yield curve than most of us do. He looks at the 3-month rate today versus the 3-month rate in the futures market 18 months out. And he says that's the important curve. Well, that's about 20 basis points from inverting, and probably will invert after he hikes at this next meeting. So even in his world, we're at a point where it's obvious that policy is restrictive. And he also knows that if he inverts that curve, that implies that the Fed's going to be cutting rates somewhere down the line. And he has said that means the economy is weak. So, maybe he looks at that and says, we do need to slow down. I don't know. If he sticks to what he said in the past, if he really believes that about the yield curve, that's what he should do. I just don't know if he's going to do it. It's going to be an interesting week, put it that way.
So let's talk yield curve. Last week when we did this report, the 10-year 3-month had inverted long enough to blink your eyes and went back up. But this week, now then, it has solidly inverted. We're on recession watch. What happens now?
Well, that doesn't really mean all that much. As I said in the piece, look, lead times from the inversion of the 10-year 3-month curve over the last 4 recessions is about 14 months from the inversion to the onset of recession. And during a 14-month period, a lot of things can happen. So it's not that it means we're obviously going to have a recession. I mean, people look at this yield curve stuff and some other indicators, and they think they just mean that they're always right, and that they mean that you automatically take certain actions. Oh, we're going to have a recession. I need to sell stocks and buy bonds. Well, maybe, but when? I think people shouldn't take these things as these certainties that they think they are. And I would also point out, too, that when I first got in this business back in the early 90s, or 1991, nobody knew really what a yield curve was and what its relationship to recession was. And now everybody knows what it means, or what they think it means. And I am a big believer that once things are so well known, they don't have the same predictive capability. And we've seen that repeatedly throughout history and markets. My favorite example is what we used to call the dogs of the Dow. Back in the early 90s, it was a big deal, the dogs of the Dow. You bought the 5 or 10 highest yielding Dow stocks at the beginning of the year, and you held them to the end. And it was this outperformed the market all the time. Yeah, until everybody started doing it, and then it didn't work anymore. I'm not saying the yield curve doesn't mean something. It certainly does. But we don't know the future, and we don't know how that indicator has been affected. I wonder if we've had this bear market already. We're down 25% at the low. Did we discount a recession already? I don't think so, but I don't know that for sure. And like I said, a lot of things could happen over the next year, from the inversion to potentially the recession. Of course, it doesn't have to be 14 months like it has the last. That's the average. It could be as little as 9 in that case, or as much as 21, which was the length of time, the longest length of time preceding recession. So, I mean, there's no way to know what that time frame is going to be. Heck, it could be a month. We just don't know. So look, what it means is that we're watching for other things to confirm that signal. The 10-year 3-month curve has inverted prior to every recession in the post-war period. Okay, so we're on watch. What are we watching for? We're watching for things like credit spreads. We want to see credit spreads. If they widen out where people are avoiding junk bonds, that would be an indicator. That's not the case right now. Look, I think the high yield spread last week was 4.5%. It's under 5. That's just normal. That means nothing. That's just about average. So there's no stress in the credit market. So that is not telling us anything at this point. We haven't seen earnings estimates have not come down for the S&P 500. I mean, they're really holding in there quite nicely, and earnings have been good. You would expect earnings to fall in a recession. We're not seeing that in the forward estimates. So there's other things that we need to see to say, okay, this is how we're getting closer. Right now, all we have is the initial warning, and that really doesn't mean all that much at this point. Doesn't mean we got to do anything. It means we got to start watching some other things. Of course, we watch those things all the time, so it's not anything new.
So one last thing today. I had a slight correction last week in interest rates and the dollar, but still both of those are in an uptrend. But isn't there some opportunity there? And we're watching for that when one or both of those begin to weaken.
Well, yeah, look, when you have big trends change, that's when opportunity will present itself. If the dollar gets in a downtrend, there may be an opportunity in gold or some other commodity. If interest rates start to fall, you can obviously make money on the longer duration bonds. And by the way, that's another signal for that potential recession, would be that the yield curve starts to steepen actually just before recession. And it does that because short-term rates start to fall faster than long-term rates, because it's anticipating that the Fed's going to cut rates. We're not even close to that. Rates are still on an uptrend. The dollar's still on an uptrend. They have corrected a little bit back down to the trend lines. That's all they've done so far. So we haven't had any trend changes in those big metrics that we watch. When they do, if they change, well, then we probably will have some opportunities to make some money. And we look forward to that. We'll believe me, we're watching it very closely.